5 years ago, that answer was different. I think a lot of people came to market saying, all right, I'm going to start small with maybe just Bitcoin access, no send receive, no yield capability, no stable coins. And that was maybe a good enough wedge in the door. Today, the market has just matured so much, and there are so many great options now for investors that I think if you want to be competitive, you need to have a broader capability earlier on in your journey. We don't want to do the, half-baked version of this product. We want to do the one that is the most novel and the best for investors.
Hi everyone, welcome to the Converge podcast at The Defiant. I'm joined today by Brian Foster, co-head of infrastructure at Coinbase. It's great to have you here on the show.
Well, thanks for having me, Chris.
Yeah, so excited for this conversation. This has been a very exciting year for the infrastructure side of crypto, tokenization, with a lot of new players coming into the space for the first time. So just so we get started, can you please walk me through what being head of infrastructure at Coinbase really means and who your clients are, what kind of products are you looking at today?
I'm happy to do that. Coinbase does a lot of things these days, and so it's useful maybe to start with just a high-level orientation of how we organize the business. And so, as you said, I co-head the infrastructure business. Infrastructure at Coinbase, you can really think of as the complement to our first-party business, right? So if you go way back in time, Coinbase started as a retail platform where people could come and mostly trade crypto, right? That was what the business was primarily about. Over time, we evolved to serve more types of first-party clients, family offices, hedge funds, other types of asset managers and institutional clients. But we also recognized that outside of those first-party clients, there'd be a lot of other types of brokerages, banks, fintechs, payment services providers, really what on Wall Street you might call the sell side, right? Who would want to also participate in this market. And we said, we've gone really deep on building infrastructure to support our first-party business. Let's take all of that expertise and that platform and turn it into a product that can help those infrastructure first players on the sell side, if you will, in addition to the first party clients. So it's a very complementary business and something I think we were well equipped to do, given how we started in going really deep and building a vertically focused first party business.
So that means that would include both what you might do, for example, for BlackRock and their ETF in holding the custody of the Bitcoin or Ethereum, but also providing sort of crypto services for other fintechs and TradFi players who provide crypto services to their end clients. And who are those type of institutions that today look at Coinbase for those type of services?
Yeah, that's exactly right. So to try to simplify things, there are many products in the infrastructure platform, but they're really centered around two main categories. One is about enabling trading and access to our markets. And so we provide all kinds of tools related to market connectivity, custody, staking, data, financing as a service to financial institutions who want to help their own clients access crypto markets, right? And the ETFs, I think, loosely fit into that category. They're really about access to crypto as a financial asset class, where we play the role of custodian and prime broker. The other major category, which recently has been a very high growth part of our business and really the market at large, has been, of course, about enabling payments. And we've had this, I think, really big moment in the last year or two where stablecoins have gone mainstream as a tool, not just to support, trade settlement and really the investing side of the crypto market, but actually have now become a new payment rail accepted by PSPs, fintechs, and money movers. And so we're hard at work arming that second major category of client type, fintechs, banks, PSPs, and money movers. Core business includes payments and really supplementing what they already have today with that crypto native rail, the blockchain, the on and off ramps, the wallet infrastructure, and the stable coins themselves so that they can enable better payments for their clients.
Great. And if we think about that first bucket, then the more access to crypto for institutions and so on, how has that changed? Because if you think even from a retail perspective, the appetite for digital assets has evolved over the years. We had very good years, very bad years, but at the same time, we have always talked about institutions finally coming to a space and institutional capital is coming. So from what segment are you seeing the most demand currently? Are you focused today on enabling, let's say, a regional bank in, the Midwest and helping them give their end clients access to crypto trading so that they can hold Bitcoin or whatnot? Or are you more focused on, okay, let's see something. Franklin Templeton is, launching their proprietary trading and they need access to all of this and they don't want to retool. What's driving demand on that side of the business today?
Great question. The ultimate demand comes from, the buy side, from the investors, if they will, right? Whether they are retail or institutional. And so, as you know, that demand has been growing over the years, but has also been cyclical with, the core, what I would think of as crypto native assets like, Bitcoin and ETH and Solana. And so that demand ebbs and flows, but over time has really grown as crypto has become what I think really is a standalone and new asset class. From the infrastructure business, the way we think about this is the demand side for infrastructure is a little bit more, maybe a bit smoother in how it grows relative to that end client demand, because the demand for infrastructure is really a function of which fintechs, neobanks, brokerages, and exchanges want to offer crypto trading, right? When we think about that trading bucket. And so that curve really followed a steady progression of, first, who is really technically equipped to contemplate what's kind of a thorny problem, right? With like thinking about digital assets, and am I really equipped to do due diligence on a Coinbase and understand wallets and private key management and markets and 24/7. So there was a little bit of a readiness and a technical sophistication factor that made some of the faster moving fintechs and neobanks and brokerages the early movers in that category. I think regulation also played a part, right? As the regulatory backdrop has improved, more of the conservative institutions like the PNC banks of the world have started to come in and partner with us. So that's been really the story of the curve of the demand curve on the trading side of infrastructure. First, fast moving fintechs, neobanks, brokerages, now more conservative traditional brokerages and banks who are a little bit more sensitive and patient and waiting for that clear, unambiguous regulatory green light.
And they still prefer to do it through a third party, like infrastructure provider. Because if I go back a couple of years, if I was a bank, I wouldn't want to offer this service directly because, I don't know, like I wouldn't have the clarity from the OCC on whether I can even hold digital assets in my balance, whether I can like operate this safely. And that would mean that probably I would want, to deliver on the customer value proposition, like the product itself, but really not get my hands dirty. Do you see, so like, and that goes both ways, right? In one sense, it'll be, okay, I definitely wanted a partner previously because I didn't want to get exposed, but today it might be, okay, now everybody's getting this. I don't want to be the last one not having this in my home banking app.
Yeah, I think that the answer is going to vary a little bit depending on who you talk to, but that's great for us, right? Some players in the market who we work with, they really want the whole stack from an infrastructure perspective. And they're starting from a place of maybe open-mindedness and saying, I'd like to have the best product capability, right? And when people start there and they start to do the due diligence and understand the technology and look at what we have, the choice to partner becomes natural because you can make a very clear argument that I want to have the best product. I should use the best infrastructure components to make that product really, really powerful. There's obvious other considerations like speed of market, economics, right? What is it going to cost to do this? And how scalable is the thing, right? If I'm going to make an upfront investment in whether it's a partnership or in-house build, I know that this market's going to grow. And so I need to work for the long term. And I think more and more partners, as they've done that calculus, have concluded that at least a large share of what they're going to need, but in some cases, all of it, they will partner on underneath the hood. And others will say, for a variety of reasons, hey, I have a great technical capability in-house or a strong sort of institutional bias towards building, to which we say, that's great. And even those firms still usually need something, right? If you think about the most extreme example, maybe a firm says, I want to build everything. I'd like to build custody and all of the wallet capabilities and permissioning and logic and maybe even brokerage, right? But Coinbase operates at the infrastructure level, our markets businesses in a vertically integrated way. And so even those players will still often route trade flow to our exchange. So we find there's always something to do. And in many cases, there are 5, 6, or 7 things to do, even for these large partners.
Yeah, and how are you seeing the enablement side on the TradFi or, like fintech or even trading partner on things like the compliance, the risk management? Because when I work with banks, they have never faced something like a Chainalysis or have to do with travel rule or the idea of, okay, here you have to go look not only at direct exposure, but also like indirect exposure. So how how does that process of incorporating digital assets into the rest of the stack looks like for your clients?
I think for the firms that are the most sensitive to compliance, it actually plays to Coinbase's strengths. So we welcome those conversations. You're right that for particularly a lot of the traditional financial institutions and large banks, this is a sensitive spot where the way that compliance needs to happen in the crypto world, which includes all of the on-chain monitoring, that's a novel capability that all these firms need to understand. And so what typically happens is in an education and due diligence process, there's a chapter, right, that we in our run book, which is about on-chain, crypto native compliance. And we have a great set of capabilities that come off the shelf when people work with our platform, but also we encourage all of our large clients to supplement that with their own in-house monitoring. And because they have, regulatory oversight, typically, in 3 or 4 different ways, they're going to need that anyway.
Yeah,
Exactly. So we get to say, look, we're going to get you from here to here and put you in a great position. And by the way, help you feel confident about this and educate you, but you're going to stand up this, to get you from there to there, right? And do that in-house.
Right. We'll talk more about payments in a bit, but I also wanted to touch on like the capabilities. So custody, trading, liquidity, and deal flow, which is like liquidity flow, which is something huge. But there's also this integration with, the banking or the fiat, the cash leg of transactions. So now Coinbase has received conditional OCC approval. Why is that needed? And how does that become part of like the differentiation that Coinbase has in this space?
Sure. The simple answer, we haven't been public, obviously, about all parts of our strategy. We are a publicly traded company. But the simple answer for why we pursue sometimes these additional regulatory licenses is often that it gives us flexibility to, number one, develop new types of products, or number two, engage certain client types or certain clients in new jurisdictions that maybe we couldn't otherwise. And so broadly, I can say that getting that OCC charter just affords us a little bit more flexibility in terms of our ability to design new product, but also be to serve specific types of clients, and is a supplement really to the great licensing foundation we already have, right? And so that's how we think about really generally getting new licenses.
And are you seeing like an increasing sophistication in terms of what people are doing with digital assets? Meaning, a couple of years ago was enough. Okay, you'll have access to a handful of digital assets that we are okay in terms of like compliance and regulatory client data or whatnot. But are today things like staking, yield, DeFi integration becoming more relevant? And how are you like implementing that?
I think that the simple answer is that more and more of the clients we work with that fall into this brokerage and financial institution category recognize that if they're going to be competitive and have something today that is up to par with some of the leading capabilities on the market, they're going to need, 4 or 5 dimensions out of the gate from a product perspective. So, 5 years ago, that answer was different. I think a lot of people came to market saying, all right, I'm going to start small with maybe just Bitcoin access, no send receive, no yield capability, no stablecoins. And that was maybe a good enough wedge in the door. Today, the market has just matured so much, and there are so many great options now for investors that I think if you want to be competitive, you need to have a broader capability earlier on in your journey. And so I think that's helpful for us from an infrastructure perspective, because we get to say to all of these partners, great, we have all of those things. So we can pull that timeline forward for you and make you competitive on day one. And by the way, if you watch our product showcases, we're continuing to ship product at a super fast rate. And so our job in the infrastructure business is to help keep all of those partners and clients we work with on the frontier, so that when their investor wants the next thing, we can say, you're going to have it, and just really accelerate their ability to build for their clients.
And now switching to the other side of the payments part of things. So just in terms of context, still most of what you see in crypto in terms of volume still relates to trading of some nature, and only a small fraction has to do with real world payments, B2B, or even like P2P remittances. All the use cases are still a small fraction, but it's been growing rapidly. How have you seen that evolution play out, and what has the implication of that been in terms of like the products that you've launched or your roadmap? Because it's moved really quickly.
It's moving super fast. And I think it's true that backward looking, trade settlement and stablecoins as a quote currency against other crypto assets have been really the predominant way that the market kind of bootstrapped and got comfortable with stablecoins. But you're right, today this pure utility play of stablecoins enabling payment completely independently of what's happening in trading. That is the much faster growing thing. And I would not be at all surprised if in the next few years, that's by every metric, the far bigger category. I think, look, a few things have happened. Stablecoins obviously are not new, but they've had a moment in the last year or two. And typically the way that we see these markets develop is one or two very large credible players decide, you know what, it's time. And they make a big move, and then the dominoes start to fall and everyone gets comfortable. We saw this with the ETFs, right? Working with BlackRock and a few other very legitimate firms initially. And then the dominoes fell and everybody came in. Suddenly we had a market in a new category. I think the same thing has happened with stablecoins. A few large players, there's a critical mass that began to move. And if you are competing with one of those players, you're asking at the board level and in your exec rooms, you're going, hey, like, are we missing the train?
Right.
Right. And so all of those dominoes have started to fall very rapidly. And I think what's really interesting about, that strategy question of like, do we go now or do we wait for companies in the payment space, whether you're, a fintech, a cross-border money mover, or a bank, is the stablecoin enabled payment capability touches a huge part of your business, right? It has more, trading crypto is interesting and Bitcoin, ETH, Solana, et cetera, as a new asset class. But the business rationale for making that leap for some firms has always been hard because you go, okay, this is a piece of my portfolio. Now, of course, with tokenization, that case is getting stronger because it's more of the portfolio. But contrast that reality with stablecoins, where on day one, you're going, this actually could be a substitute for my payment rails, period, right? And so I think for the folks contemplating doing something here, the question of integrating stablecoins is much more existential, right? It's going to potentially touch all of my flows globally. Question of kind of when and how fast that happens. And so there's urgency. And that's what's been exciting. And we talk to these firms, the smart CEOs understand that, 3, 4, 5 years from now, they actually may have more stablecoin volume than they have fiat volume. So they're all at the table and eagerly, somewhere on the journey of building. And our job in the infrastructure business is to work with them on, number one, developing that strategy. But number two, arming them with the tools to build great products where the stable coins are really working in the background, but to their end clients who are often, merchants or businesses or retail, it just feels like a simple native payments experience.
Right. Like a balance. One of you mentioned, like dominoes falling, and we haven't really seen as many dominoes fall as what we saw this week with the OpenUSD. So a couple of questions there, but do you see that as this sort of like fundamental shift? Because you have, Visa, Stripe, Coinbase, everybody and BlackRock as well. And so you have both the trading and the payment side. Do you see that? How would you characterize like this happening?
I think it's a really exciting moment. I think something worth clarifying about Coinbase's role in this stablecoin market is that, obviously we are super bullish. We're long stablecoins. We think this is a fundamentally important technology that is going to really help upgrade the financial system, consistent with our mission, and obviously just a huge strategic priority for the firm. To do that, Coinbase's role is to be a platform, right? And so we have a long-standing history with a couple of stablecoins we've supported, most notably USDC, which continues to be a huge focus for us and will be a huge focus well into the future. But we're also a platform. And it's our job as an infrastructure provider and as a markets business serving a really wide, divergence of sort of different types of customers and clients to respond to their needs and to support a range of assets, just like we do, by the way, in our trading business. So I think that's our position, to be this platform that supports the leading assets, specifically on OUSD. I think what's exciting is just how many big names are involved right out of the gate, right? They're not small firms. And so that to me is just a marker of where we are in the maturity of this market, that you have more than 100 really large, credible firms with distribution who are ready to invest in this. Now, there is a cold start thing, right? And some of the really large stable coins have incredible scale and network effects and are being used. So I do view this as, it's day one, but certainly the people around the table, this is the right mix where something really interesting could happen.
Yeah, it's been a big year for press releases in some way, because when you look at, for example, Tempo, that you have like dozens of design partners, dozens of ecosystem partners, but adoption still is to be seen. But let's say something like OUSD really like holds on and like Everybody's super excited and we see some momentum. Do you see this also as a fundamental shift in how, the stablecoin economics are going to be distributed? Because everybody's been super concerned with that. You see that in the Genius Act discussions around, like stablecoin yield, all the problems that we saw there. And for Coinbase in particular, the relationship with Circle has been really important in terms of, getting that kickback and sort of like building the economics of the business. Do you see, in some way also, issuance has become commoditized and everybody has their own stablecoin. So why do we need something like OUSD? I would assume that you will go along the lines of saying, well, we are a platform, so we have to support whatever our institutional clients need. But if you were to put yourself on the shoes of all these smart CEOs, is this just greed for the yield that's driving this? Or are we really, should be looking forward for new use cases and new ways in which, like stablecoins, like OUSD are going to be used?
It's a good question. I think empirically what we see when we talk to businesses and merchants and end customers of stablecoins, to a degree, they're actually agnostic about the underlying asset, which is interesting. They're just saying, solve my problem. I'm trying to help someone get my money from A to B efficiently and cheaply, right? And so to that end, you go, all right, which of these assets are good enough from a sort of institutional credibility, the way that they're structured, the regulatory oversight, the backing, and there's a few of them that are, on a path to clearing that bar or already have cleared it, but it's a small group. So you need to be able to do that. But then the client, again, is typically saying, I just need my payment to work. So you asked an interesting question of how might the economics shift? Coinbase, as you said, is a platform. I think what's interesting for us is that, we have our own owned and operated distribution, if you will, right? And fundamentally, the way economics in the stablecoin world have been so far about distribution. And so Coinbase is in a great position, I think, regardless of which assets we support to benefit from that distribution. And then for the end clients and partners, all they really need to worry about is this helping me get my money from A to B efficiently? And Coinbase is an infrastructure provider. Are you supporting the assets that clear that bar?
Yeah, and it feels also that Coinbase has an important role in something that's becoming more of a pain point today, which is this, it's getting fragmented in such a way that last week we had MoneyGram on the show. They'll have their own stablecoin, platform XYZ will have their own stablecoin and different ways of issuing those. But you still need venues where you can go from one to the other. Is that part of the play here where like Coinbase would be, the liquidity engine for multiple stablecoins, and that's part of the value prop, I guess?
That's exactly right. We're already in a great position to do that. And although we haven't maybe marketed this explicitly as product, it's integral to what we're already doing, right? We think about this as really like the stablecoin clearinghouse. And so you can come to Coinbase today and get access to most of the major stablecoins, easily swap them in and out for each other. We'll be in a really interesting position with USDC and OUSD by virtue of being a place where you can, on and off ramp it at a huge scale. And we control, obviously, the economics when people come through our platform. And so we'll continue to be that central clearinghouse and infrastructure platform. And that's a really interesting role to occupy, I think, in the market.
Great. Okay, so let's move on from payments into the other hot topic, which has been tokenization, RWAs, tokenized securities, perpetuals, all the different types of assets. So everybody says it's a huge priority. Everybody's doing something. You see all the job listings for people in like digital asset strategy, delivery, whatever. Still a fairly small space, and the typical, this is 30 billion, then stablecoins are 300, and then crypto is 3 trillion. So it's still 2 orders of magnitude smaller, depending on how you count it. So, and again, to the point around like press releases and announcements and roadmaps and good intentions, what are you seeing sort of like being real today and like actually solving problems? And I'll let you go in whatever direction you like, but is it more on the enabling access to different asset types, or is it more on, okay, we have terrible, outdated technology and infrastructure and rails that still hold us to T+2 settlement, and that is overdue for replacement? And which of the two are you seeing sort of like more relevant today?
Coinbase as a firm has been maybe very conservative, arguably too conservative in avoiding the sort of press release game in this category. But substantively, the investment we've made here has been very real. And we have a couple sort of hardline positions that are maybe a little bit different than some of the other big players, particularly the folks coming at this from the traditional finance, incumbency. And one of our big hardline positions is we don't want to do the, half-baked version of this product. We want to do the one that is the most novel and the best for investors, right? And central to that is one-to-one backing and these being real tokenized assets, not, what's effectively a derivative product or something that has, high slippage or hidden fees. We want it to be pure and real and a direct expression of the underlying asset that token is wrapping, right? And so that's been a diehard position for us and how we've thought about building the product. In terms of the way we're going after the market and how we're unlocking this to create real value, first, it's super early, as you pointed out. This is a small market, partly because of there's still major regulatory work happening here domestically in the US. But first, the obvious thing for us to do is to help really make this about an access play. And so for the non-US market who we've initially engaged, we're offering these tokenized products to people who we believe have demand for certain equities and other instruments we can tokenize. We can just reduce that friction for access. So that is a very obvious out of the gate value prop. The longer term value prop, obviously, is we want to really, I think, create a new surface on which to build new products.
Okay.
Right. And so to me, like what's interesting about the access play and bringing certain investments to new clients is of course exciting. But I think the bigger prize and more interesting part of this long term is what can you build that you couldn't build before? Because these assets are on chain, they move 24/7, they settle near instantly, they settle very cheaply. And I think that if we build this market correctly, we're going to have all kinds of almost a renaissance of financial product innovation derived from this new product format.
But is that mostly a retail play? Because even in emerging markets, like you can get a account purchasing through your broker dealer, or many of the like fintechs today even have brought access to ETFs, US stocks for many years now, and there are like aggregators that are built on top of the the US, so like trading infrastructure. So myself, as you can tell, I'm not from the US, and I've been trading US stocks for almost 10 years abroad. So who are we really providing access to that didn't have it? And okay, and if that is real and there's a concrete benefit there, the second part, we still haven't seen it, right? People actually building things on top, because I would love the idea of, okay, I have my whatever SpaceX stock and now I'm going to use it as collateral on Have and take a loan. So how real are the two things, or is it mostly an expectation of a new world where these are the default rails?
I think that it's super early, so we have to bear that in mind. And typically these things have a gestation period. We saw, obviously, blockchains went through a major, scaling cycle like every new infrastructure does. But we had, the invention of blockchains predated really the growth of the best DeFi products by years, right? So it took a little bit of time. I think we're going to see something similar. I expect it might go faster in tokenization because we now have a snowball effect and developers in a real industry. But I think step one is just simply getting these products out in the wild for the first time, right? And we'll see about demand. We're humble about it. We don't know is the answer, but we do know that for a lot of investors, outside of the US and other certain regulated markets, it's much easier to engage with, a non-custodial first wallet and experiment there than it might be for someone who has the ability to get, banked and get a KYC brokerage account. So we do think there is a delta there in terms of access and demand. And then in terms of the products being built on top, I think it'll just take a little bit of time.
Yeah, and it's also like the relative size of the two spaces. It's significant, right? Because, the trading volume of retail customers in Latin America, it's, I don't know, like probably the rounding error of institutional trading in the US.
Right.
So, but I do see the point in like, okay, we'll build this, and in the same way that you've done for the like ETFs and for like crypto as a service access, then the institutions will come, and then it becomes more efficient, and there will be this transition to the new rails. But at the same time, it's with the increased regulatory clarity in the US, it's become easier for DTCC, Nasdaq, NYSE, everybody to get on board with the crypto rails. What does it mean? What does that mean for like a crypto native company or infrastructure player like Coinbase? Is it more competition? Are you seeing specialization? How do you think that might play out?
We generally have a view, we're not cavalier about competition But what we found over the years is that when large incumbents enter this market, it tends to grow the pie. And Coinbase is a broad enough company with both our first party and our infrastructure and developer, businesses, that we found ways as a firm to benefit from that pie growing and partner with the folks who are coming in the door. I do think specifically on this vector of, building markets for tokenized products, there are still many, it's early, and there's firms who are taking different approaches, and they're not all compatible with each other.
Exactly.
Right? And so
At all.
there's going to be this natural, battle, I think, to create standards. And Coinbase has a view that, we're really students of Silicon Valley history, and we have Silicon Valley DNA. I think we're a little bit of a platypus, half Wall Street and half tech, right? And, we have a view that open standards and open protocols tend to win out. So our bias is towards do the thing fully on chain, right? Make it truly crypto native from day one. And figure out how to make that thing compatible with Wall Street, and figure out how to shepherd that model safely within the regulatory framework. But let's not compromise just because it's done this way today. Right. And so we are probably on a spectrum like here, feel. And I think some of the firms with different models may be a little bit more conservative or happy to do something closer to maybe the very nice business that they already have working today. And so that's how these things go. But, I expect there will be a phase where we figure out where that clearing point is for what the standard ultimately becomes. And then as a firm, Coinbase traditionally has figured out how to make that work.
A couple of weeks ago, we had the DTCC here on the show, and it's really exciting to see how early they have been in the space, like all they're doing in terms of tokenizing. I don't want to get you in a complicated position with the question here, but my take from what they are doing and others are doing, it looks more like core technology replacement. We're going to adopt this technology because it's going to allow us to move into same day settlement and 24 something 5, 6, 7 sort of like trading and settlement. And we're using technology infrastructure networks that allow us the degree of control that we feel comfortable with. And you see, for example, the massive investment that has gone into the Canton network that in a way replicates the closed or walled gardens of the past.
Right.
And if I stand from a crypto native perspective, many of the institutions that are now building those types of infrastructure are the names that you would have, like the cypherpunks or early crypto adopters thinking, crypto is meant to eliminate this type of entities because they will no longer be needed, because by definition and almost by their mandate, they're meant to be intermediaries between people. So the way I understand it, and you correct me, of course, is like Coinbase sits on this crypto native side of things, or helping Wall Street make the transition to these new rails. But at the same time, there's this other side, which is adopting a few of the more technology-led aspects of the ecosystem, but not its open permissionless, composable nature. So it's a really broad question, but I wanted to get your sense of how do you see the ecosystem evolving in that dimension into the adoption of new ways of trading versus replicating what we currently have, and sort of where will Coinbase sit in that container?
Sure. I would love to tell you with total confidence this is exactly how it's going to pan out, and this is the right model, but I can't do that. What I can say is, I think that everybody who is investing in this market is kind of acting rationally from where they're starting from. Right. And so you called out some very well-established players who are doing amazing work, innovating, and have traditional financial services roots. If you're in that position, it makes a ton of sense to say, I want to think if this is technology that I can use to do an even better job servicing my existing clients, lock them in, make my products better. That makes total sense. But I think we're, even a lot of those firms have recognized and come a long way in understanding that even if they have success in some of these models that may be a little bit more from Coinbase's position, a little bit more like a compromise or a little bit more permissioned or closed, I think they recognize now that there is enough unique distribution in the crypto native world and a separately fast moving train in that direction that they're going to have to figure out, if they want to play in that market, how to make their thing work with it. Right. And we've seen that, if you remember, 6 or 7 years ago, I know you've been in the industry a while, we did this whole same song and dance around blockchains themselves, right? We had a big cycle where Wall Street and a lot of large enterprises said, I'm going to build a closed permission chain. And of course, that's the right way to do it. And a lot of them were, very well reasoned. and sounded smart. And, over here you had the open public chains, which ultimately grew a lot faster, right? So that's not to say it's going to play out exactly in parallel to that. But what happened is there were experiments in both directions. And ultimately, I think those firms who started with a more kind of closed and permission strategy ended up adapting and building bridges. And we ended up partnering with many of those firms and building products with them together. I will not be surprised if something similar pans out here. And also, I think, look, these are the world's big place. The financial markets are enormous. There are different client archetypes in different geographies here. And it's like, we're very like positive sum thinkers at Coinbase. I think it's very likely that, the Coinbases of the world have solutions that work very well for certain client archetypes in certain geographies who have biases towards, certain product formats. And also these other traditional financial institutions can win. The question is going to be, how do we build the bridges where they're needed to make those two worlds interoperable?
Are there any unlocks still pending? So I can think of the Clarity Act still, it's to be seen whether we can make it this year or not.
Yes.
But, a lot has changed. So is there something like in your checklist that is missing for, this being the greatest wave of adoption and of, crypto infrastructure?
Well, with the sort of version 1 of Coinbase's product strategy, which we've just announced at our showcase a couple of weeks ago, the lights are green to start really with this push towards, ex-US on-chain tokenized assets. And so we're really pursuing that with vigor. Obviously, domestically, the Clarity Act is still, being debated. You'll have to ask our policy team for their latest views. They can speak to that in much greater depth than I can, but, still ongoing. And obviously that would be a huge unlock in terms of just, certainty around here's how these assets will be treated and the market structure will come together. So I do think that is a really important moment for the US. And then even once that green light happens on, the regulatory structure, the markets have to get built, right? And that is an organic process that's about building products and competition and innovation and takes a bit of time. And so, I think that could take us another, year or so, let's see, to get really off the launch pad, even following that green light from the domestic regulators. But it feels like everyone is kind of ready with what their strategy will be, and we're going to run the experiment.
Nice. So if we were to sit again, let's say 12 months from today, what is the metric that you would like to highlight?
It's a great question. On that last, we've covered a lot of territory today. On that last topic of tokenization, I'm certain we will have more product and more users out there using these things in the wild. And so I think we'll have a much, so all of those basic KPIs should be up and to the right, around active wallets and users of these tokenized assets, more, I would say, total AUM, if you will, of tokenized products, certainly including stablecoins. But I also think we'll have a sharper view about the question you asked around what's really driving demand and where the value is, right? And we'll be able to see, okay, over here, yes, over here, no. And perhaps even some of the early more interesting products that I alluded to about, okay, our investors and, maybe asset managers going to come in and combine these things and actually take advantage of smart contracts, right? So I expect we'll have progress along all of those dimensions. Yes. And then certainly in the stablecoin side, I think the TPV numbers are going to continue to grow. That's a thing that's totally orthogonal to everything happening in trading. It's just PSPs and fintechs and banks coming in, aggressively to start to build the pipes and then put flow through the pipes. And so those are kind of all the big picture things that I'm watching for and expect we'll have up and to the right 12 months from now.
Yeah, that makes sense. And in the way they reinforce each other, which I think is some of what we have discussed today.
Yes.
Well, great. It's been fantastic having you on the show. Looking forward to having you again in 12 months from today and see if everything moved to the right. So yeah.
Thanks, Chris.
Thank you so much.
Great.